Okay, let's start out with a discussion on goodwill here. First off, this section causes a lot of people problems because there seem to be a number of formulas that can be used to calculate goodwill, which is true. So there's purchase price of an acquisition, or what's paid for an acquisition, usually the total value of the acquisition, minus book value. And remember, book value is just another name for shareholders' equity. That's one way you could do it. Or you could do purchase, typo again here, purchase price minus the fair value of book value. That is also equal to goodwill. Or you could do purchase price minus the tangible book value. That's also equal to goodwill. Any one of these formulas can be applied. Oftentimes, it's this one that tends to take priority, the purchase price of an acquisition minus the fair value of its book value. Now, the reason why this takes priority is because oftentimes the book value or the shareholders' equity of a company does not reflect up-to-date values on the asset side of the balance sheet. One big reason for this, and they don't go into a ton of discussion about this, but fixed assets like property, plant, and equipment are often recorded at cost. So if things like property, real estate, factories, commercial buildings, etc., that a company may own on their balance sheet have not been updated in terms of their most recent values, and perhaps those assets have been sitting on someone's balance sheet for 20 years, 30 years, or some long period of time, and they may have appreciated in value since then, even when accounting for accumulated depreciation over that time period. The book value may be somewhat understated relative to its fair value. And the whole purpose of goodwill is you're looking to calculate how much in excess of the actual asset values, net asset values, assets minus liabilities, is being paid when it comes to a company acquiring another company. So let's talk about this a little bit here. So as an example, let me make another dialog box here. So let's say, as an example, we have a company being purchased for $90 million. The company has a book value of, let's say, $30 million. However, it has a fair value on its book value of $50 million. So the question might be here, well, how would we approach goodwill and what would we use? So for a question like this, where it's fairly straightforward, they're not throwing a lot of numbers out at you, it'll have a fairly, a more simplistic or a less daunting approach than if you were to have a whole balance sheet given to you, which we'll do in another video. But for now, they might ask some question like, which is most accurate? And they could give you a bunch of multiple choice answers saying goodwill is higher than anticipated, goodwill is lower than anticipated, goodwill does not exist, and perhaps goodwill is negative. So between these, we would have to choose which one is the correct answer. And in order to get a sense of what they mean by is it higher than anticipated or lower than anticipated, you have to kind of know the steps of how an acquisition works. So first things first, like we said, you need the purchase price. So we know the purchase price for the acquisition is $90 million. So take a hypothetical situation. Let's imagine that you run a coffee shop and it's a very successful coffee shop chain, and someone like Starbucks approaches you and says, hey, we'd like to buy you out. They want to buy you out for $90 million. They've got a sense of how much you sell, they've got a sense of where you're located, they're really interested in your locations, you have a great reputation, etc. They want to pay you $90 million. Let's also assume that this perhaps is a multi-generational coffee business. It's been in your family for ages, and sometime, in the 1980s or 1990s, there was some real estate purchased and where the coffee shops now reside or now do business and operate. And those are still on the books at their original cost. So the book value, as a result, ends up being this low number, like we talked about in the setup of this question, of $30 million. Keep in mind, again, book value is the same as shareholders' equity. Sometimes they call it net assets. They also call it net worth. There's a whole bunch of ways to describe book value, unfortunately. But nonetheless, it's $30 million. Now, if Starbucks asks you as the owner to take a look at your assets and liabilities on your books, you're going to be showing them a figure of $30 million. The people at Starbucks, of course, would not be so unknowing that they wouldn't realize that, how accounting rules work. But for the sake of this exam, we do have to assume that potentially there is a lag, and certainly during transactions, this is often the case. There is a lag between discovering what the true value or what a fair value is for the assets on a balance sheet relative to what has been recorded as the values of these assets. So in terms of what the goodwill is with the information that Starbucks has at the moment, they've offered you a $90 million purchase price offer. They know that you have $30 million of goodwill, of book value. And so they're calculating the goodwill as $60 million. Now, this is where the second part of the question will come in order to tell whether or not it's higher or lower than anticipated, or whether or not it exists, etc. So they believe they have $60 million of goodwill based off of the value they believe they're receiving according to your balance sheet. However, like I was saying, they're going to get their own accountants to take a look at what the fair value is of the assets on your balance sheet, because, like I was saying earlier as well, this $30 million does not reflect an updated value, or what would be known as a fair value. And they will need to record the true goodwill on their balance sheet based off of the fair value, not off of what your book value was worth at the time you showed them your balance sheet. So if we take a look at the net asset value or the shareholders' equity or the book value of the updated value, which is known as the fair value, then the goodwill is going to look like a smaller figure. Because, again, remember, to Starbucks, this is $90 million in cash going off of their balance sheet. In turn, they're receiving $50 million of assets minus liabilities, including furniture, real estate, coffee machines, refrigeration units, etc. So the $40 million that's left represents the amount that they paid above and beyond the $50 million of physical assets that they're getting for your business. And again, that goodwill is an intangible asset because it's going to count the intangibles of why someone pays more than the actual value of the assets that they receive, which includes things like reputation, location, maybe customer lists that have been accumulated over the years but are not recorded on the balance sheet, etc. So overall, considering all of this and the updated value of the book value of your coffee shop, when Starbucks pulls that onto their balance sheet, they're going to say, in fact, that they actually only paid up $40 million above and beyond the value of the assets, net assets they received from you to get to their $90 million price, as opposed to earlier when they weren't aware of the fair value of your assets and they originally thought they were only worth $30 million when looking at your balance sheet, which would have meant they were paying up $60 million above and beyond the assets, which is the old goodwill calculation. So what we can conclude here is that goodwill is lower than anticipated at $40 million when compared to the original expectation of $60 million.